Welcome to The Informed Investor. Today's topic is going to be about the big ups and downs in the market, which we refer to as market volatility. I'm Mark Gochner. I'll be joined today by Jake DeKinder and Wes Creel.
I like that jacket, Gach.
I think I've been working on my game.
I can tell. It almost looks like you're like sponsored by somebody.
I didn't get the blue jacket memo. You guys should have called me.
We could. On one of these, we're going to match. We're just going to like wear the exact same outfit.
I hope so.
Yep.
I think one show we'll rotate jackets and see if anybody notices throughout the
Maybe
episode.
some different sizes. We'll see.
All right, market volatility. Again, the big moves in the market up and down. Let's just set it straight here. Everybody loves the upside. The real worry comes to down markets. Like what's going to happen if we have a big drop in the market?
Well, I mean, I think you're right on that. Right? I mean, this is almost like the classic fear and greed, right? People love the upside. They get concerned on the downside. And the question really is, what are you going to do about it as an investor? Because the reality is markets go up and down, and you got to be prepared for it.
Well, it's interesting to have this conversation now because if you look at most market-based indicators for expected volatility, they're not particularly elevated. And yet, if we look at where a lot of the flows are going, especially with the active equity ETFs, they are going into strategies that are targeting mitigation of downside risks. So it means it's on people's minds, and I think it's a worthy topic to discuss today.
Well, let me set up the conversation. We always like to read a couple of headlines here. So I'm going to start with a few, and this is going to be back more when we did see a pretty big spike in volatility, kind of early April there when a lot of conversations were going on with the tariffs. So two I want to highlight. The first one, extreme volatility sends U.S. stocks on a roller coaster ride. And the second one, markets cannot go on like this. And then I want to bring it back to more recent time. You alluded to volatility's, I'll say, softened a little bit since then. So here's one. Market volatility is set to make a big return.
There's so much to unpack in there. I like the one that, I think you said from a couple of months ago, markets cannot go on like this. And that was a period where I think it was a little bit more volatile in the markets when that one came out. And I would kind of flip that around and be like, I'd actually be concerned if markets didn't go on like that.
Yeah, what does that mean? They can't go on. They can't go on
Exactly.
processing information. That's what defines the market. So it's an interesting concept.
Big news comes out and you don't see market swings, right? I mean, people aren't adjusting their risk preferences. Markets aren't processing information. Then I would say, okay, now we've got some problems.
Key point, it's always processing information, and it should be titled, you always want markets to behave like this, meaning bringing new information into prices of any stock or any bond out there. But let's go back to that time period, early April, very high volatility. I'm going to read a couple numbers here and almost just reflect on this for a moment and get your thoughts on it. So this is back on April 3rd, around that Liberation Day time period. So April 3rd, it was down 4.8%, the market. And then the next day, it was down 6%. And then a couple trading days later, it was up 9.5%. So that's where a lot of these headlines were coming from about, this reference to chaos in the market.
Those are big days for sure. You mentioned those 2 days where it was down. I believe those were the worst 2 days for the U.S. stock market since COVID. And then you get the one really big bounce back day, which was, I believe, the best since the global financial crisis back in 2008. So it certainly is consistent with my memory of it, where those were very volatile days when with a lot going on. And when you have changing in the information set, you should expect that markets are going to be going up and down.
Well, you would think so. You also go back and look at trading volumes. On that Monday, following those two big down days, I think we saw one of the largest days of trading volume that we had seen in a long time in the markets. And then 2 days later, on that, I think it was the Wednesday, where you said you get about a 9.5% pop in the markets. Same thing, massive trading volume. And that's the point that we hit at the beginning, which is you want to see high trading volume. You want to see, I'm not saying you want to experience volatility as an investor, because I appreciate that when the markets are getting choppy, people get concerned, right? But from, I'll say, an academic standpoint, wouldn't it be weird if that wasn't the way that it was working?
It would be odd. And then you mentioned, the one really big bounce back day, April 9th, I believe it was. So what was interesting around that time period was the lesson you learned in terms of sticking with your investments, because if you look at the trailing one-year return on the S&P 500 on April 8th, so before that bounce back, it was, I believe, minus 3 percentage points. You look at the trailing one-year return on April 9th, and it was positive 6 percentage points. So there is a lesson there by not reacting to the downside because you might miss the upside.
Well, another point you always like to make is that it's the largest since it's the biggest. I mean, that's the thing you also got to appreciate. I think you just said that those two down days were the biggest since COVID. And then the biggest up day was the biggest since the financial crisis, right? And you're always reading the article. It's the biggest. It's different this time. It's the largest. And you got to be prepared for that.
Well, I like that idea of it's different this time. It's always part of that headline when you get into some tough time periods. And I go back to that Liberation Day on tariffs. Was it different? Absolutely.
Absolutely.
I mean, there's been proposals on tariff rates we hadn't seen in probably 100 years or so. So it was different. So it can become very emotional around that. But I always like to think through, too, in its idea of, have we lived through it before? And by that, I mean the big ups and downs in the market. So let me give you a couple numbers here. And this goes back to 1979. I think that's when Russell 3000 started, and we have some market data around that. So what we're looking at here are intra-year declines in ups in the market. So for example, on the declines, if the market at that point, at some point throughout the year, was down 20%, that's what we're referring to here. So since 1979, there's been 11 years where the market at some point in the year went down 20%. Now, of those 11 years, 5 years ended up being positive. 6 years ended up having a negative return that year. So I'll highlight that just to say we've been through it before as an investor. And while it is difficult, usually it works out pretty well if you just sort of stick to your plan during those time periods. Now, the other side, and we have to highlight this just because you said most people are concerned about the downside. But if you look over that time period again, 30 years, the market at some point in the year went up 20%. And of those 30 years, 27 years were positive, only 3 were negative. So what's your takeaway?
I mean, jokingly, we say this all the time, markets go up and down. They tend to go up a little bit more than they go down, right? And I think that's what you're showing right there. You do get downturns in the market, but when on the other side of it, a lot of times you have more upturns. And again, what's the market done over time? It's gone up and down, but over long periods, it's tended to go up.
Yeah, and I mean, like you mentioned, the downturns are going to be part of investing. By the way, that's why you get paid the equity premium to bear some of that risk. And then you look at previous downturns, anytime it's been down by 10%, well, over the next year, the average return for the U.S. market was almost 12%. So you look at those numbers and you think, okay, well, this is what you could potentially miss out on if you were to deviate from your investment plan.
You got to be able to stick it out. I mean, we talk all the time about, we discuss this idea of an investor badge of honor, right? And that's what I think you got to go through. Like, go back to earlier this year where you get the 2 big down days and the big up day, right? And if you stuck to your plan and made it through, you should be like, yeah, like I earned my investor badge of honor. Go back to March of 2020 for people that made it through March of 2020. Go back to 08, 09 time period, right? When you make it through these periods as an investor, you should be like, yeah, I should wear a little investor badge of honor and say, yeah, I made it through that period. Yeah, I made it through that period. And that's how you capture the long-term returns.
You should go to a cocktail party with all your little badges.
I'm going to put it right here on this blue jacket. It's going to look great, man.
They call that flair in office space.
How much flair you got,
More flair, the better.
More as an investor, more flair, the better. Yeah. That's what I'm talking about, man.
Well, Wes, let me ask you this. Periods of high volatility, or when you get in periods of low volatility, does that tell you something about expected returns into the future?
Yeah, it's a good question. The volatility characteristics themselves are persistent. We do tend to see that high volatility months predict high volatility in the next month, but there really hasn't been a reliable correlation between the volatility and returns. That high volatility months are sometimes followed by high return months, sometimes by low return months. There's really just not much of a relation there.
Yeah, those days we talked about earlier, those best days that we've seen since, usually those best days are in some of the most challenging times in the market, when markets are down low.
Yeah.
Let me ask you this then. So as an investor, what are your options? Let's say you do get into a time period, you're really worried about where the market is, you're really worried about the market's just really dropping off. What can you do as an investor?
Well, one place to start is maybe don't have the realization or make the determination of what you want to do in your asset allocation during these periods, right? You want to be prepared going into this. That means setting expectations around what the ride can be and then forming an asset allocation that kind of balances the potential upside with your tolerance for the downside. And so having a balanced portfolio is one way that you can, mitigate that.
I think that's a great point, knowing what you're getting into ahead of time. I've been reading some great books recently. Couple that jump out, actually. The Wager, that's a good one. Shipwreck off the coast of South America in the mid-1700s. Endurance, you read that one.
Yeah, I read that one too.
Yeah, that's the Shackleton. Expedition to the Antarctic. And then another one you recommended to me, which I think was Undaunted Courage. And that one was awesome. Meriwether Lewis.
Fantastic book.
Oh, man, fantastic book. And the reason I bring that up is that you're talking about being prepared for what's coming up, right? You're talking about setting appropriate expectations. And when you think about that adventure, right, they didn't know exactly what they were getting into, but they had the right mindset, they had the right gear, they prepared the best that they could, and they faced some insane challenges along the way. And when they did, what did they do? They jumped into action and they executed the plan. They didn't panic. They didn't freak out, right? And as an investor, panicking is really never a good investment approach. It's a good lesson in life and it's a good lesson in investing, but that's not how you want to approach that.
As you're talking, I think about too, it's knowing yourself.
Yeah.
As well. I think about my father-in-law, for example, probably as risk averse as you can get as an investor. He just couldn't handle these big swings in the stock market. So for most of his investing career, most, if not all of his money was in like CDs and really safe bonds, fixed income, because he just couldn't handle the swings. And while as an investor, he probably left a lot of upside on the table. I think it was absolutely the right decision for him because he could sleep at night.
That's a really good, I mean, it's an excellent point, right? It's impossible for us to say what, we get that question all the time. Be like, well, what's the right asset allocation? Be like, that's absolutely impossible to, I mean, I think good financial professionals working with investors can have that conversation, but it's really tough to answer because you have to kind of look inside yourself and say, what can I stomach?
This is why I don't play golf. I can't handle the ups and downs. Right? And I think that's a really good point that, the appropriate asset allocation is one you can stick with. And in the case of your father, that was something that was safer. And some other investors might be able to handle the ups and downs of the stock market, might not even look at their statements very often. And so to them, it just looks like the market is going up and up smoothly. But I think, understanding what you can tolerate in terms of market volatility is an important thing for investors to learn about themselves.
It's funny that point, not look too often. You just look at this year, right? We already talked about what we went through. We talked about Liberation Day. We talked about high volatility. Through June 30th, I think the S&P is up about 6% for the year.
It's amazing.
It's amazing, right? And if you look at the long term of the S&P, it's about 10.5%. I think it's right at like 10.4% over the last 99 years. So, it's almost like if you went to bed on January 1st and woke up on June 30th, you'd be like, yeah, I got roughly the average.
Yeah,
whereas it was a pretty choppy
year.
Yeah, but as we know, there's no really normal year in the markets. You want to expect the unexpected.
Well, you think back to even 2023, getting to be a stale anecdote at this point, but there was a lot of consternation. There was a lot of turmoil that year, whether it was geopolitical stuff, financial issues with the United States, and yet the global stock market was up, I think, 23% that year. So, this is a really good example of when you look back and say, wow, we ended up getting a good market outcome despite what I was reading about in the headlines.
And what were you feeling during those periods, right? I mean, you go back to some of those choppy periods, and in the moment, it seems like the biggest deal. And it's funny, we ask investors all the time, like, you go back and be like, so what was the big event of 2019? They're like, I don't know, right? 2000.
Yeah, you forget after the fact.
I don't know, right?
Very quickly.
So in the moment, you're feeling this emotion. But as you start to extend that time period, you get out a little bit, you almost forget, well, what the heck was going on? And again, if you just stuck to your plan, you're like, it was probably fine.
Wes, you made a comment earlier when we were talking about some of the flows we're seeing in the industry now, going into some of these, I'll say, products out there that can minimize some of the downside. Expand on that a little bit in terms of what you're talking about.
Yeah, I mean, again, that's a reasonable conclusion to have if you were concerned about market volatility, is I want to do something to mitigate the potential downside. Then you want to be evaluating, well, what is the appropriate way to do this? We already know that you can do that effectively by combining fixed income with your equities. There are new breeds of solutions that are focused more on equities that will have the allure of lessening your downside risk, but it might come at the expense of your upside participations.
Yeah, there's always a cost to that. We should make that one of the.
That's a good topic.
Is dive into some
real good
things that are out there and sort of the associated costs.
Yep, be fun to unpack.
Minimizing that downside. All right, so a couple things. Jake, you say this, and I think it's totally appropriate. Always expect the unexpected.
It's a good mindset as an investor.
And in markets go up a lot more often than they go down. Mm-hmm. What would you add to it?
Expected returns are positive, right? When we talk about stocks, expected returns are always positive. And so when you have these periods of market volatility, you don't want to lose sight of that.
I think you guys nailed it.
Thanks for joining us today on Informed Investor. As a reminder, enable notifications for future episodes. And with that, have a fantastic rest of the day.